Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, stock analysis, again, following on from some chats I've been having with our friend Stephen from the Unemployed Value Degen, going to be talking about Douglas Elliman real estate and why I think it's an interesting opportunity, what I think it could be worth over the coming years. Please do like and subscribe to the channel and make this information free. So please, it doesn't cost you anything to like and subscribe, but it does help me out a lot in terms of the algorithm. If you're interested in having, I suppose, me do the work for you, you can check out the portfolio that I manage on eToro. The link will be in the description, and you can literally just copy that. A disclaimer today, guys, I'm giving information that I cannot necessarily, I can't verify. It's not advice. I'm just a guy giving my opinions and ideas out there, sharing it with the world. So please do take that into consideration. Nothing that I say here today is advice, as you should know and be responsible. Business. So Doug, the ticker, New York Stock Exchange, Douglas Elliman Incorporated. It's a real estate brokerage, really, and property technology investment companies, probably uh, a little bit grandiose, I would say. However, it's a type of business that I think does fit the capital light inflationary beneficiary model, because there's a certain amount of scale you can achieve with such a business model. And it might not be as good as, let's say, a royalty or an exchange, but I think that there's some opportunity in this particular space. So the investment case for Doug, I'll keep it very simple. The chart's roadkill, but it's a very, very solid balance sheet and liquidity profile. I do not think it's going to be a zero. I think it's probably not a zero. It's trading for less than its book value with, look, somewhere around 150 to 200 million in terms of liquidity. And depending on how you calculate that, I think that there's some misunderstanding around the balance sheet. If you see the interview I did with Stephen, he really describes it quite well in terms of what he and I, for that matter, believe the market is missing when it comes to this company's balance sheet. So if the management can cut the costs down, I don't like their SG&A. I know that they're a realtor and you got to pay your agents and all this sort of stuff, but I think they can continue to do a better job there, which they are. Sales return to just a reasonable level, close to where they were in the past. I think that that will allow for free cash flow, a positive inflection. And when the market sees that, they've been loss making in the last 2 years. When the market sees that, it will start to revert closer to, well, if not 0.8 times book value, at least 1 times book value. I do not consider unreasonable. And the thing is a 2 to 3x on that return. So it has the liquidity to survive for quite a while before that turnaround, and it's got some multi-bagger potential. If you think that there's a windfall coming where lots of real estate transactions, particularly in the high end, which is where these guys operate, they're taking a clip on increased volume and increased prices due to inflation. So that would be the inflation beneficiary aspect of the thesis. They can benefit from an increase in price, increase of transaction volume via their commission structure. Their expenses will not rise quite so fast. That's my take on the company. As of time of compiling this, the stock had really tanked to around about $1.05. All I wanted to point out here is that the enterprise value has been calculated with having 54 million of revenue as deferred revenue calculated on the liability side of the balance sheet. And I think that that's short-sighted, and I think it's a misunderstanding. I think it belongs on the other side of the balance sheet. This represents condo sales they've already made. They do not have to deliver a new condo, being a real estate broker. So I think that's actually going to drop straight to the bottom line and surprise quite a lot of people. The street's targeting this stock at around $3, which is in line with what I think. So I'm not sure if that makes me confident or less comfortable. In any case, a price to book value of less than half certainly has my interest peaked, provided that they have the liquidity profile, and I believe that they do. Here's a look at the chart. It's been absolutely shellacked, given that they were loss-making over the last year. So here's what I'm talking about, and here's what Stephen and I talked about in the podcast. So hopefully this gives a little bit more clarity. You've got a screenshot here on the left of the asset side of the balance sheet. Okay. So yes, you should go through, and not probably, you should really strike a line through the goodwill. It's not really a tangible asset. You could strike through the other intangibles. You could change this total asset valuation. That's fine. I get it. The point is, here's the amount of cash they have. Here are the receivables. And let's just, for a moment, take that at face value and say that trailing 12 months, they've got 460 million on the asset side. Before we delve any deeper, we go to the liability side and we've got 265 listed on the liability side of the balance sheet. Even if we just stopped there and went home, this gives you an idea as to what the book value is being calculated as, and it's trading at a really steep discount to that book value. However, a little bonus, I think, is this unearned revenue line here that's due to come in, I believe, mid 25, if not end of 25. So there's roughly $54.5 million worth of revenue that's already been sold that is going to be accounted for, given the wonky accounting rules, next reporting year, I believe. That's the story. So why should that be on the liability side of the balance sheet? I understand when Starbucks pre-sells a gift card, it's a liability because they receive the cash, but they still got to deliver a cup of coffee in the future. But this isn't, as far as I can tell, this is not the case with this company. They're a real estate broker. They are not on the hook to deliver the condo or the house or whatever it is that they've sold. They've received the revenues. They just haven't put it in the accounting. They haven't entered it into the accounting as of yet. And provided that they've paid their brokers their commission, there may be a percentage of this that doesn't all fall to the bottom line. That's fine. But goodness me, even if it's only 50% of that, really that should be on the other side of the balance sheet, as far as I'm aware. And so I think that the discount to the book value, as steep as it's being reported, I think is even steeper in reality. So point is, I think the stock's cheaper than what you might think at first glance. So if we move all that across, just to have a play around, the assets would then be recalculated roughly 515 million. Your total liabilities would be obviously that minus the 54 million in deferred revenues, so 211 million, 92 million of which would be current, so due in the next 12 months. That's about the same amount of cash that they've got on hand according to their accounting. The revised book value there would be, okay, asset minus liability, you get 304 million, divided by the shares on issue, 91 million. You're looking at roughly $3.33 per share in that new book value. Now, I mentioned before that if you took out the goodwill and the intangibles, it would be lower than that. You feel free to do you in regards to that. We've got a rough estimate as to the book value. So what would the market reasonably pay for that if we're looking at a book valuation? So very short listing history. So it's not reliable really to use this. But if you look at the mean since they've been listed, it's trading at just less than 1 times book value. That is not unreasonable in terms of a valuation metric for this type of company. Okay. So what about earnings? That's the other side of the coin. If they start to really generate some more revenue, generate more earnings, if the market were to value this thing on an earnings basis, what might that look like? So I don't know exactly what their commission structure is and how much of their revenue would fall to the bottom line, etc. But we can use 2021 where they generated 1.2 billion. And yes, I know that was a funky year due to COVID and whatnot. But these guys operate in high-end real estate, so they're going to have lumpy revenue cycles, I believe. They're estimating 1.2, let's call it 1.3 billion as of next year. So let's just for a moment assume that that comes to pass. What percentage of that might come to the bottom line? And then let's use a market multiple, okay? And see if that, even if we use conservative valuations, and see if that promises further investigation. So the PE ratio of small caps is around 12.6, and even that is considered historically low. Okay, so that'll be our multiple. I'm going to use a 10x multiple. Let's say that in 2021, off 1.3 billion, they generated $1.23 of earnings per share. So if we get close to that over the next year, is it unreasonable to expect $1.2 of earnings per share? Maybe. You decide. I'm just here saying what if. If we use a book value and we use a 1 times price to book, you'd expect a target price of around $3.30. If you believe this company can earn $1.2 in earnings and the market's willing to pay even 10x PE for a small cap, then you're looking at $12. And if you took an average of the two, that gives you an idea somewhere around $7.65 in terms of what the market might be willing to pay for this in future. Based on the current price of $1, that's roughly 700% or 7x on the upside. And if this took a long time, longer than you expected to play out, let's say, if it took 5 years to come to pass, if this were to happen, you'd be looking at a 51.5% IRR. So a little bit of patience here, I think, could well pay off. So I am long the stock. It's in my public portfolio, and I'm adding a little bit of stock also to my private portfolio. It does have multi-bagger potential, as you've seen. I believe it's got the liquidity runway to survive a little bit of a cash burn from a few down years. It's treated as if the current predicament is permanent, and I don't think there is. They've made some losses thanks to certain settlements from lawsuits and obviously just a depressed market turnover. I think it's a speculative, so there are a few things, who knows, that could go wrong. I'd be limiting it to sort of a 1 or 2% max is what I'm thinking in the publicly available portfolio. Private wealth portfolio, probably a 1 or 2% as well. So that's it, guys. I hope you enjoy that. Please do like and subscribe, and I look forward to catching up with you in another video shortly. Take care.